Welcome back, America, to Sound Retirement Radio, where we bring you concepts, ideas, and strategies designed to help you achieve clarity, confidence, and freedom as you prepare for and transition through retirement. And now, here is your host, Jason Parker.
America, welcome back to another round of Sound Retirement Radio. So glad to have you tuning in to episode number 396. The title is Understanding FDIC and NCUA Insurance, What You Need to Know. Okay, before we get started, I like to get the day started right by renewing our mind. And this verse comes to us from John chapter 1, verses 4 and 5. In him was life, and that life was the light of all mankind. The light shines in the darkness, and the darkness has not overcome it. On a side note, I took my family to see this new movie called Jesus Revolution, and my kids, teenagers, both said that they liked it, and my wife and I, we laughed and cried. It's a good movie. I encourage you to check it out. Where do fish keep their money? In a riverbank. What did the football coach say when he went into the bank? I want my quarterback. I've had a few emails and phone calls with people asking about the safety of their banks. Should they change banks? Should they diversify across banks? What's protected? And so on. So in today's show, I want to answer some of those questions and give you the resources you need to evaluate your bank or credit union, and also answer the question of how much protection do you have? Remember, articles, links, and resources are available at soundretirementplanning.com. Just click on episode number 396. Before we dive into this episode, I'd like to share a quick story and a few lessons I learned. I was out playing pickleball 2 weeks ago, and it was really competitive. It was my first time playing indoors, and I had the opportunity to make this shot, but in order to make it, it required me to dive. And it was a beautiful dive. I was stretched out like a Major League Baseball player flying through the air. What's even more remarkable is that I made the diving shot and we won the point. But in my headfirst dive, I felt my shoulder separate as I hit the ground. It was incredibly painful. And now I have limited movement in my arm without feeling like my shoulder is getting ready to fall out of the socket. After the win, I thought, well, that was pretty stupid. I'm almost 50 years old, and I'm playing pickleball like I'm 18 years old and unbreakable. And it made me think about some of the people that I've met recently who are about to retire, but they're investing like they're 18 years old. Remember, once you retire, you will become much more focused on cash flow and constructing a portfolio to deal with one of the biggest risks that you face when you retire, which is sequence of return risks. I'm getting ready to record a YouTube video that explains this risk in greater detail, and it shows you, using history, why this is such an important concept. And if you'd like to see the video, you can join our email list at soundretirementplanning.com, and I'll email you when it's ready. Or you can subscribe to our YouTube channel, and I'll include a link there if you'd rather subscribe to YouTube. But I just wanted to remind you, whether you're playing pickleball or investing, you need to play the game a little different as you age. Here are a few quotes about banking. Bob Hope says, "A bank is a place that will lend you money if you can prove that you don't need it. If money doesn't grow on trees, then why do banks have branches?" J. Paul Getty says, "If you owe the bank $100, that's your problem. If you owe the bank $100 million, that's the bank's problem." Warren Buffett says, "If you get to my age in life and nobody thinks well of you, I don't care how big your bank account is. Your life is a disaster." Deposit insurance is one of the significant benefits of having an account at an FDIC-insured bank. It's how the FDIC protects your money in the unlikely event of a bank failure. And the standard insurance amount is $250,000 per depositor per insured bank for each account ownership category. So what is the FDIC and the NCUA? FDIC stands for Federal Deposit Insurance Corporation. NCUA stands for National Credit Union Administration. Here's what their websites state. The FDIC, Federal Deposit Insurance Corporation, is an independent agency created by Congress to maintain stability and public confidence in the nation's financial system. The FDIC insures deposits, examines and supervises financial institutions for safety, soundness, and consumer protection, makes large and complex financial institutions resolvable, and manages receiverships. NCUA says that they were created by Congress in 1970. It's an independent federal agency that insures deposits at federally insured credit unions, protects the members who own credit unions, and charters and regulates federal credit unions. So how does it work? FDIC insurance was established in 1933 in response to widespread bank failures during the Great Depression. Its primary purpose is to protect depositors from potential losses in the event of something like a bank failure or if a bank faces insolvency. Interestingly, deposit insurance in 1933 was $2,500. The FDIC first paid claims to depositors of failed banks in the mid-1980s. By insuring deposits up to $250,000 per depositor, per institution, and for each account ownership category, it bolsters the stability and confidence in the nation's financial system. When a bank fails, the FDIC steps in to facilitate an orderly resolution, either by finding a healthy bank to assume the failed institution's insured deposits or by reimbursing affected depositors directly, providing invaluable peace of mind in today's uncertain economic climate. So let me give you an example of how the FDIC coverage would work. And for this example, I use the FDIC ED calculator, which I'll include a link to in the show notes. In this example, we'll assume a hypothetical couple named John and Nancy. Here are the accounts that they have at one FDIC insured bank. John has an individual savings account with $300,000 in it. John and Nancy have a joint checking account with $500,000. John has a business account with $375,000. Between these three accounts, John and Nancy have $1,175,000 on deposit with the bank. So the question is, how much of these deposits are covered by FDIC insurance? What's your guess? John's savings account that is owned by him only, it's an individual account where he has $300,000. Well, on that account, only $250,000 is insured. $50,000 is not insured. John and Nancy have $500,000 in a checking account at this particular institution, and this account is fully insured because John and Nancy are each covered for up to $250,000. So all of the $500,000 is insured. Now, let's say they had $501,000. In that scenario, $500,000 would be protected, and $500 for each of them would be uninsured. And then he has this business account with $375,000, but the FDIC limit is $250,000. So in this account, $125,000 is uninsured. Of the $1,175,000 of money on deposit at this bank in these three accounts, $1 million is protected by the FDIC because the insurance amount is $250,000 per depositor per insured bank for each account ownership category. Because they have three different ownership categories and two people on the joint account, they have $1 million in deposit insurance across three accounts. One thing to keep in mind with Silicon Valley Bank and Signature Bank that failed recently is that the FDIC has said that all deposits will be protected. And this is pretty incredible because PBS reported that 94% of SVB's deposits and 90% of Signature Bank's deposits were uninsured. Here's how the FDIC press release read on March 12th. After receiving a recommendation from the boards of the FDIC and the Federal Reserve and consulting with the President, Secretary Yellen approved actions enabling the FDIC to complete its resolution of Silicon Valley Bank, Santa Clara, California, in a manner that fully protects all depositors. Depositors will have access to all of their money starting on March 13th. No losses associated with resolution of Silicon Valley Bank will be borne by the taxpayer. We are also announcing a similar systemic risk exception for Signature Bank, New York, which was closed today by its state chartering authority. All depositors of this institution will be made whole, as with the resolution of Silicon Valley Bank. No losses will be borne by the taxpayer. Now, this idea that there won't be any losses borne by the taxpayer is really kind of silly. If the insurance that the banks have to pay for FDIC insurance increases, guess who's going to pay higher bank fees? Now, when you're entrusting your hard-earned money to a financial institution, it's crucial to ensure that they offer protection and the security offered by the FDIC. To verify if a bank is backed by the Federal Deposit Insurance Corporation, you can start by visiting the bank's website. They usually have the FDIC logo on there. Or you can call the FDIC, which you could call them directly at 1-877-ASK-FDIC. Or you can visit the link that we'll have on the show notes, and you can actually do a search and find using the bank find tool to find out if your bank is FDIC insured. The other tool that I found that's helpful is a website called Bauer Financial. Bauer Financial does a star rating system for banks. I'll include a link to Bauer Financial, so if that's something you're interested in, you can look at the star rating of your bank. Okay, so banks versus credit unions, what's the difference in protection? When considering the question of protection for your deposits, it's an important distinction to explore the difference between banks and credit unions. I worked for a bank up in Alaska for years, and I remember the president of the small bank I worked at talked about how the fact that credit unions are nonprofits, and as a result, they can offer usually higher deposit rates and lower fees on their services. And the president of our bank said that it's very, very hard for them to compete with credit unions. Credit unions tend to be more community-oriented. Now, banks, being larger and more widespread, often provide a more comprehensive suite of services and because they can benefit from economies of scale, allowing for relatively higher levels of stability. On the other hand, credit unions are member-owned. They're nonprofit organizations designed to prioritize the financial well-being of their local communities. Consequently, credit unions can sometimes offer higher returns and lower fees to their members. To ensure the safety of your deposits, both banks and credit unions are covered by separate but comparable government-backed insurance. Traditional banks are backed by the FDIC, while credit unions are protected by the National Credit Union Share Insurance Fund, NCUSIF. Both insurance policies offer protection for up to $250,000 per account holder, ensuring a robust level of coverage in the event of an institution's failure. In addition to the FDIC calculator, I will also include a link to the NCUA calculator. In today's digital age, safeguarding your financial assets has become more important than ever. We've got all these cyber threats that continue to evolve, making it essential for individuals and organizations to employ additional security measures. And so aside from the standard protection methods such as strong passwords and regular credit monitoring, it's also a good idea to consider using things like multi-factor authentication to enhance the security of your online banking or investment accounts. Now, with the retirement budget calculator, we recently added multi-factor authentication to the retirement budget calculator. This authentication method requires more than just a password and can significantly minimize cases of unauthorized access. Additionally, it's critical to update your computer software and firmware to fend off potential breaches. FDIC deposit insurance only covers certain deposit products, such as checking and savings accounts, money market deposit accounts, and certificates of deposit. Things like mutual funds, stocks, bonds, or annuities that you purchase from a bank are not covered by FDIC, even if they were purchased from an insured bank. One of the cool tools I found on the FDIC website lets you run financial reports by institution, and I'll have a link to this specific tool in the show notes. Once you click the tool, you can sort the data to discover the largest banks by total assets. And you probably remember during the financial crisis, the term too big to fail was coined. Well, if you're with one of the largest banks in the country, I can only imagine that if we were to see more banks get into serious trouble, the federal government will probably decide that certain institutions are too big to fail, and they will likely step in to protect our financial system. FDIC insurance is an important factor to consider when deciding where to save and manage your money. With FDIC coverage, you have the security of knowing that your deposits are protected up to $250,000. But if your funds exceed that amount, or if you're unsure about whether or not your bank is insured by FDIC, it's always a good idea to look for additional protections for your funds by spreading your deposits across several different FDIC or NCUA insured institutions. Credit unions provide similar levels of coverage, and they may offer additional services that make them attractive alternatives for depositors. If you're getting ready to retire, you're going to want to read my new book. It's called Retirement Calculator: How Much Money Do I Need to Retire? Retirement is likely the greatest financial decision of your life. As you're getting ready to retire, and if you want more peace of mind timeline and confidence that you can retire without running out of money, be sure to check out the Retirement Budget Calculator so that you can start organizing your finances as you prepare for retirement. In today's podcast, we discuss the importance of understanding FDIC and NCUA protection for your deposits, which offers protection up to $250,000 per depositor per insured institution for each account ownership category. In the show notes at Sound Retirement Planning, just click on episode number 396, and you can view the resources mentioned in today's show. And I'm going to have links to the ED, which is the FDIC estimator, to help you understand how much of your deposits are covered by FDIC. I'll have a link to Bauer Financial for star ratings on your bank. I will have a link to the NCUA calculator for estimating coverage at your credit union. And in today's show, I also highlighted the need to practice additional security measures such as multi-factor authentication, regular credit monitoring, and maintaining and keeping your computer software and operating system and security all up to date.
Information and opinions expressed here are believed to be accurate and complete, for general information only, and should not be construed as specific tax, legal, or financial advice for any individual, and does not constitute a solicitation for any securities or insurance products. Please consult with your financial professional before taking action on anything discussed in this program. Parker Financial, its representatives, or its affiliates have no liability for investment decisions or other actions taken or made by you based on the information provided in this program. All insurance-related discussions are subject to the claims-paying ability of the company. Investing involves risk. Jason Parker is the president of Parker Financial, an independent, fee-based wealth management firm located at 9057 Washington Avenue Northwest, Silverdale, Washington. For additional information, call 1-800-514-5046 or visit us online at soundretirementplanning.com.